Hi, everyone. I'm Maggie Lake, and I'm talking markets today with Brent Donnelly, president of Spectra Markets. Hi, Brent. It's great to see you.
Hey, Maggie, good to see you too. Happy
So,
September.
yes, wow. I know we keep saying we just slammed right in from summer, right? It really feels like that. And today was no exception. We walked in and it was like, oh, the selling seemed like it was back. It was an ugly looking picture, steep losses. And then we started to see a rebound led by tech. By the end, all the US indices had ending in positive territory. We are coming off a presidential debate and last night, and of course, we had inflation data today. So what do you make of the trading session? I'm gonna figure out where that audio is coming from that I'm hearing.
Yeah, there's a lot of stuff going on, obviously, specifically to today. I think that, and this isn't hindsight. I mean, I'm wrong plenty of times, but I was right in this case because I was writing about the last couple of days. But this inflation report just isn't that important. If you look at what commodities are doing and what's going on in China, what's going on in Europe, September inflation is going to be low. So it just didn't really matter. And
Mm.
honestly, I was surprised even by the size of the reaction initially, because I think people generally kind of understood that going in, but obviously not completely. But if you look at what oil prices are doing or what RBOB's doing, and how that's going to flow through to unleaded gasoline prices in September, you're going to have quite a bit of disinflation going on in September. So to me, today's number is not really important. What's really important is trying to figure out where the labor market is, because there's essentially two ways of looking at it. One is the SOM rule kind of approach, which says once momentum starts in the labor market, once negative momentum starts in the labor market, that's it. It just always unwinds and you get a recession. And that's the whole point of the SOM rule, which basically says like when the moving average of the unemployment rate goes up X, then you're coming into a recession. And this has some logic to it. Like it definitely has historical precedent. But then on the other hand, if you think about the labor market in 2021, 2022 was just clearly unsustainable, like strongest labor market in the history of the universe, then pulling back to levels that are similar to 2017, 2018 isn't necessarily all that scary. So
Mm.
it's kind of one of those levels versus changes situations. And we'll put them in the show notes. I have a bunch of charts. And so if you look at JOLTS or initial claims as two examples, like, yeah, JOLTS has come off from 12 million to 8 million. But if you look at what it was before 2019, it was like 4 million to 6 million. So the number of job openings is still very high, even though it's come down from like stratospheric levels. And if you look at claims, the same thing, like, yeah, we're ticking up. And usually that's a sign, a negative sign of bad labor market momentum, but we're just back to where we were in 2018, and that was a pretty good economy. So I'm not as convinced that the recession trade is really the trade. I actually think we're in more of like a mean reversion situation where you get 2% GDP, 2.5% inflation. And then looking at stocks, if you wanted to pick between two outcomes, 50 basis points and a recession, like 50 basis point cut from the Fed and a recession, or 25 basis points and no recession, like obviously the second one's better for stocks. So the fact that they're not going 50 in September, the market tries to trade that as bad news, but honestly, I think that's good news. The,
Yeah,
major mega cuts from the Fed are usually bad news, as we saw in like 2000, 2008, 2020.
that's so interesting. And it really I think the last few sessions, the last few guests I've been talking to, and I feel like all of you really try to watch what the market's telling you and kind of look beyond the headlines. A lot of you have been saying you just don't see this recession coming or a deep recession coming fast and furious. Why are those headlines so persistent? Where do you think the
Um,
disagreement's coming from? Because I think it's confusing people.
Yeah, I think there's a couple of things. They're mostly behavioral things. So one is that there's a cohort of analysts that tend to predict recession, and the switching cost for them is very high. So they're going to look for evidence of a recession and then broadcast that. So like say Ally, financial mist and warned about the consumer yesterday. So a lot of people who are more bearish on the economy take that as anecdotal evidence of the shit is hitting the fan for the consumer.
Mm.
Or same thing with Dollar General and Dollar Tree. But then in the show notes, there'll be a chart of Dollar General, Dollar Tree, Costco, Walmart. And if you look at all those, I mean, two of them are going to all-time highs, Walmart and Costco, and two of them are absolutely collapsing, Dollar General and Dollar Tree. So I feel like sometimes there's a cherry picking problem where you can find evidence of your thesis and then broadcast it. And the second thing is that there's a negativity bias in the media in general that recession stories are more exciting and get more clicks. And if you're trying to optimize for clicks, then you put the word recession in your headline because that's more exciting. And honestly, like the rates market isn't fully priced for a recession. If we were actually pricing a recession, there would be way, way more cuts priced in. I mean,
Yeah.
we're only all we have is going back to somewhere around neutral. So um, even though it's in the zeitgeist a lot and it's in the headlines a lot, I mean, a recession's not priced in.
I think that's really important, and it does, you're right, it is the way it seems to operate, and it is causing some concern, but I think it's really important to clarify that. That's why we're always talking about trying to sort of separate out the noise. So talk to me a little bit about the other big news event and talk about noise. The presidential, it was the first, maybe the last US presidential debate last night, between Trump, and Harris. There's a lot of, there's an entire industry of pundits pulling this thing apart every which way. Do the markets care? It was a very muted response. I mean, listen, a lot can change between now and November. Is this a market event or is this just spectating and politics?
So it's tricky because it can potentially be a market event, but it really depends not just on who wins the presidency, but also what the composition is of the House and the Senate. Because if you get a red wave or a blue wave, I think that's just a completely different economic situation than like Harris wins, and then you have like a Republican Senate and Democrat House. To me, that's actually a completely different outcome than a sweep one way or the other, because that's a
Mhm.
lot more gridlockish, which tends to actually be okay for markets. So, in the show notes, there's the evolution of the odds on the three outcomes. So there's the red sweep, the blue sweep, and then Democratic president, Republican Senate, and Democratic House, like I said. And the sweep odds actually didn't move that much. So if anything, I guess like, the consensus is that Harris won the debate. It keeps her credibility alive as like a viable candidate, obviously. Like it's obviously net it's good for her. But in terms of market moving events, I don't really see it as a huge market mover. What the big market movers are the sweeps, because then you get radically different tax policy. You get, obviously, if Trump wins, you get tariffs,
Mhm.
but a red sweep, you get a lot more, probably like more fiscal, more tax cuts. So the ability to enact legislation, I guess, is a key. And if we're finding that middle ground with blue, red, blue, then honestly, I think that's basically status quo. And that's kind of like a volatility killer, which would be okay for stocks. So net, if you look at what has changed today versus yesterday, the top line odds of who's going to win the presidency changed a bit, but overall, I would say the composition of how things look hasn't changed that much. If you look at like really, really zoomed in baskets of like Democrat winners versus Republican losers, they did move a lot today. But overall, for the broad market, I think unless you have visibility on what tax rates are going to be, which we don't now, it's still way too far out,
Mhm.
then I just don't think it matters. And then, like I said, I think you position for a red wave or a blue wave if those become apparent. But now, honestly, if you look at the odds of those three outcomes, it's like 30, 25, 22 or something in terms of percentages. So it's really like a three-way race between those three outcomes, and nothing really changed since yesterday on that
Yeah,
front.
and I would argue when you're talking about taxes that even if we know who wins the election, what they say during campaigning and what they actually do are there's such a huge difference between that, what they can actually get
Right,
accomplished that,
absolutely.
there's gonna be gaming on that all along. And thankfully, some people are going to do a deep dive into that because wow, following that tax legislation is tough work. Let's jump out of the U.S. for a minute. I've been really anxious to talk to you because I know you follow the Bank of Japan really closely. There's been so much conversation about the yen. It was at the center of that huge sort of market volatility we saw in the summer. Then everybody seemed to get over it and move on. And then we came back into September again. What's happening with the yen? What do we need to understand about that situation?
Well, nothing's happening. It's unchanged on the year.
Which in and
So,
of itself is
yeah,
notable, right?
yeah, we came in at 141 and we're 141 right now, which is absolutely mind-boggling. In July, there was this narrative that the Japan had lost control. The wheels were coming off. The yen was going to collapse. Asian currency crisis. I mean, that was 2.5 months ago, and obviously none of that came to pass. The way generally that intervention works, so the Ministry of Finance intervened twice, once in April, I think, and once in July. And people tend to poo-poo FX intervention because it doesn't work instantaneously. Like they don't just take dollar yen from 160 to 125. That's just not how it works. But what they can do is change the momentum and then pray for something good to happen in macro. And essentially that's what happened, right? So the MOF intervened, then rate cut pricing in the US started picking up. So rates going down is generally worse for dollar yen. And then the Bank of Japan hiked. So then you got the rate differential compressed even more. And here we are. And then we got non-farm payrolls and the whole like VIX Mageddon or whatever.
Mhm.
So essentially we've done one huge crazy round trip from 140 to 160 to 140, which are pretty big moves, like 20 yen, even percentage wise. Like we've had years where dollar yen moved less than 10 yen in an entire year. So we've got like a 20-figure round tripper in whatever that is, 9 months or less than 9 months. So now it's funny with the yen. So it's like the ultimate Veblen good where people just the cheaper it is, the more people want to sell it, and the more expensive it is, the more people want to buy it. So generally people want to buy dollar yen on the way up and they want to sell on the way down. So now there's the theme now is kind of like Bank of Japan is kind of hawkish and they're going to raise rates, and then Japan will eventually bring money home, and that's good for the yen. Honestly, now I think it just comes down a lot more to US.
Mm.
So if you look at like US interest rates going from like a quarter point to 5.5 or whatever, and then you look at Japanese yields going from negative zero point 0.1 to plus zero point 0.1 or whatever. So you're talking about very, very small moves. And even JGBs going from like 20 basis points to 100 is not like life-changing stuff when the US is moving in 15 basis points a day sometimes in 10-year yields. So I think now we've kind of re-equilibrated. I don't know if that's a word. I don't think it is, but whatever. We found a new equilibrium where dollar yen kind of makes sense again relative to where US yields are, relative to what the Bank of Japan's doing. And then now it becomes a story of, are we going to recession, or are things going to settle down and then people will start looking for carry trades again? Because really, like the yen was one side of a carry trade against Brazil, Mexico, US dollar, Australia. I mean, everyone was just short yen against everything.
Mm.
And that unwound. If you look at like a chart of CFTC positioning, it's the biggest unwind ever in CFTC yen positioning. So essentially those things, like they say, it's like you go up the escalator and down the elevator, and that's a textbook yen move. And it's the same thing as in 1998 and 2007. It happens here and there, and so now it's pretty clean. And I think now, being in equilibrium with positioning kind of flat, then you just got to make a call on US yields, and whatever yields are going to do, that's what dollar yen's going to do.
So that answers one of my questions, which was, what is happening with that unwind? Is it unwinding? Or people putting it back on? But you are suggesting that we're in a kind of neutral state here. I think the reason that it got so many headlines, you hinted at it before, but this idea that there would be this, repatriation. It was trillions of dollars. It was a complete disaster if you listen to a lot of the pundits, it was this huge wall of selling. And yes, they would do that to buy yen or buy Japanese assets. But the flip side of that is that they would be liquidating all of the US assets that they had been buying for the better part of 15 years.
Right.
Was that just sort of hysterical doom mongering, or is there some legitimate concern that we may be in a different regime where we are going to see different behavior coming from domestic Japanese investors and they will be looking for home opportunities at the
So,
expense of US assets?
yeah, it's a good question because I think the confusion comes from the fact that there's 2 cohorts here. So the one cohort is like people that are trying to earn the carry and they want volatility to be low and they're just trying to clip the coupon. And that would be like hedge funds, CTAs, even real money, asset managers. And that could be Japanese, European, US, whatever. So they use yen as a funding currency and they tend to get out when the shit hits the fan. So that's the cohort that got out and they got out quickly and they're out. Bigger picture, if you look at Japanese investors as a total, it's an absolute stupid number of like a stupid amount of money that Japan has saved, and a lot of that money is abroad. And so, but in order for that money to come home, you really need a change in global risk appetite. Like a one-day shock isn't going to do it for like people with 5, 10 year time horizons. So
Hmm.
what you need is like real fear. And I mean, to be fair to like the prognosticators that were saying like this is the end of the world, it could have been because like if that fear that one day had continued, then at some point, asset managers in Japan go, okay, this is really bad. We've got X, Y, and Z. Like in 2008, they said, okay, this is, the mortgage there's a massive mortgage problem here and the financial system in the US is about to collapse. Let's bring our money home. But you need something like that. Like it's not like stocks are down 4% and the Japanese post office says, okay, we're going to repatriate all our yen. It just like they don't move that fast. So that whole like mega carry trade is very, very slow moving. And the changes in preferences are very slow because like their switching cost is high. They got to
Mm.
have like 10 meetings and present it to the board. And then they say, okay, we're going from 33% foreign assets to 25. And then that 8% switch could be like 10 billion, Aussie yen that they have to sell. So the flows are gigantic, but it's like a freighter or like a aircraft carrier, and then the CTAs that are doing the carry trade, that's like the jet ski that all those guys already turned.
I love that analogy so much. It's important to remember. Listen, thank goodness there's some money that's not fast moving. After what we saw with Silicon Valley Bank, we'd be in a
Yeah.
lot of trouble if everybody could execute that quickly, and we're all on jet skis. That would be a disaster. And you want to think about that. But it's a great distinction to make, and it reminds me of a lot of what the pain and that sort of hangover of trauma from the great financial crisis, because that period of selling that you referenced was so long and so brutal and just
Mhm.
felt like the never ending death spiral. So yeah, that's why we still are always afraid of what's coming up. And on that point, I just want to first of all, hi everybody in the chat. It's so good to see you. Hi Bo, welcome back. We want to know where Ralph is. If anybody can find Ralph, tell him where we are. I don't know if the guy's on Twitter or what, but we miss him too. Um, Someone made a comment in the last show, Brent, and I just wanted to share it since we were on this. I have to find it because I wasn't necessarily anticipating it, but it really stuck with me, and it's this idea of that fear of something happening. And I think a lot of it does stem from the losses people suffered. Probably the great financial crisis, because I don't know if anybody was around by the dot-com bust, but yeah, there too, if you remember. And it was from
I was.
Sarah, and she said, she wrote in the comments when we were talking about different assets with Mish, the right choice of an investment has always been a big problem for me. I know picking a wrong investment will leave a big scare for me. And Sarah, I think you just voiced what a lot of people feel. You're not alone. I think a lot of people are really concerned of just being in the wrong thing, partially, Brent, because there seems to be so much uncertainty out there, whether we're talking about macro events around Japan or geopolitical events or regime changes or AI bubble bursting. It just seems like it's really hard to get a handle on what's coming. How do you deal with that question from your clients? And I know you just launched a new education initiative, by the way, Spectra School, which is so awesome. I'm so happy to hear about that, which is looking to help people increase their education and their understanding around markets. But how do you deal with that question?
Sure. So it's kind of complicated because my views tend to be a little bit more short term and like kind of in and out global macro. But I know enough about investing and investment choices and honestly, I think the bigger risk to people's portfolios or to their wealth is the ins and outs and trying to time things and selling at the wrong time. Like if you look at there's this mind-blowing chart that I saw one time where they went into like 2 million Schwab accounts, and so you see that over 10 years the returns of all the different asset classes. So it's like stocks were 10%, whatever, bonds, debt, da, da, da. And there's like 10 asset classes and they're all like 4% to 10%. And then the average return in those accounts was like 2.2%. And this was like a massive sample size. So they analyzed why. And the main reason was because people get scared, right? Which is the
Mm.
natural human instinct. And they sell at the worst possible time. And then they get FOMO at the worst possible time and buy high. So I think, first of all, you have to decide like, what game am I playing? So are you trying to win, which is more like trading? Or are you trying to not lose the game, which is put your money in a fairly diversified portfolio and chill out? And that's why indexing is always outperforms, because there's no transaction fees and there's no over trading, and those two
Mm.
things are just the biggest drag. And if you compound a few percent a year over many years from those behaviors, it just ends up being catastrophic for individual portfolios. So I think honestly, the understanding your own psychology and then creating a portfolio that you can leave. And you have to think, okay, so if we go into a recession in 2025 and stocks drop 40%, will I be tempted to sell? And if the answer is yes, then you have too much equity in your portfolio. Like
Yeah.
you have to have the amount that you can bear the corrections, because otherwise you end up doing what everyone else does, which is like, to me, the main inefficiency in markets is like fear and greed, right? I mean, that's not just to me. I mean, that's a fact. So you have to structure your investments or your portfolio in a way that doesn't maximize returns, but maximizes your ability to stay in, like trying to get the best returns, but also adjusting for, if the shit hits the fan, will I be selling? And a big consideration that people don't take into account, which you find out the hard way the first time stocks drop 35%, is that usually you're worried about your job at that time.
Mhm.
So you have wrong way risk. If you're over your skis in equities, you kind of have wrong way risk. Like if you work for a tech company right now, you're 100% invested in S&P and Nasdaq, basically 40% of your net worth is in tech, and your job is riding on the success of your tech company. It's
You're
like working at
overexposed.
Lehman Brothers and being long Lehman stock, right? It's
Yeah.
just, so I
And
think
it's
those are
often the way.
honestly
It's often the way because people tend to invest in what they know, and so it's
right. And you believe in your company, you believe in
yeah.
your industry. But then when bad things happen in the economy, then you learn the lesson the difficult way, that you need liquidity and at the worst possible times. So I guess that's kind of a long answer, but I think you have
No,
to
it's a great one.
structure your portfolio. And also there's a quote from Buffett or something like, other people getting rich around you is not the greatest tragedy, or something like that.
Mhm.
Like if all your friends have crypto and you don't think it's right for you, just don't be long. If Bitcoin goes to $200,000, it doesn't matter, especially when it's correlated to stocks anyways. If Bitcoin goes to 200,000, Nasdaq's going to be at 80,000. So I think people need to think about their own psychology, think about the worst case scenario, and then kind of plan around that. I guess it's kind of a long answer, but there you go.
Yeah, no, but it's a great one, and it's a great reminder, and I would also say one of the other things that you can think about, know thyself. Absolutely. And
Mhm.
it's funny because we have somebody in the chat always that says no one knows thyself is their handle, which makes me laugh. But
Right.
you do have to know that. That's the ultimate gut check. But you can kind of do both, right? You can have the majority of things in some place where it suits your lack of risk if fear is driving you, where
Yeah.
you can preserve. And then you can have a smaller account that you play with to kind of build the chops of wanting to get more aggressive, right? Like
Yeah, and
they're
also
not mutually exclusive. You can do both.
like a couple of friends of mine who are kind of like pretty data driven, smart people, they know that empirically you can't beat the market if you don't have an edge, right? Like if you're just some random person buying stocks because you like the product or whatever, like the Peter Lynch model of the simplified Peter Lynch model, which is like, I like the product, so I bought the stock. Like that's not what he did because he understood valuation. But as a normal average person, you kind of should know that you don't have an edge.
Mhm.
So these people just have like a smaller account that they just do use it to satisfy that need to like buy Uber because Uber is going to revolutionize the taxi industry. But they probably had some like other pieces of crap in there that went to zero.
Yeah,
So
and learn, right?
and learn.
And
Yeah.
try to get that 10xer if you want. So
Yep.
you mentioned crypto. I've got it really perfect segue because you mentioned it, and we teased this because I was so intrigued when you wrote it in email to me. So talk to me about your outlook for crypto.
So to me, crypto is very cyclical, and to me, it's dead money for a while. And the reason is that there's just no narrative. Like to me, crypto is always about the narrative. Like there, you know what the supply is going to be, so all you need to figure out is the demand. Essentially, I mean, to oversimplify. And every single wave higher comes with a narrative that's usually pretty sexy, and recently has involved institutional adoption. So now the issue is there's just not that many crypto products left for Wall Street to launch. So like we have spot ETFs, futures ETFs, spot Ethereum ETF. They might add options on spot ETFs, but to me that's actually a vol dampener. I don't think that's really that bullish. So there's side stories going on all the time, like in Tron and Solana or whatever. But I think if you take a kind of a zoom out kind of look and look at these will be in the show notes, but you look at the ETF flows. The Ethereum one is horrendous. The Bitcoin one basically is like up down, but close to zero. Crypto didn't make a new all-time high when the Nasdaq did. Like Bitcoin did, but overall crypto market cap didn't. And overall, I feel like crypto doesn't trade very well relative to NASDAQ and gold too, right? Gold's at the all-time highs. Bitcoin's at 57K. So I feel like it's not trading well. And the reason is simple, is just that there's no narrative, and you need a narrative to get people excited. So that doesn't mean it's not going to 100K at some point when the next narrative comes and central banks decide they're going to add crypto to reserves or whatever. Like I'm not saying anything beyond like the next 3 to 6 months. I think it's going to underperform. The other way you can look at narrative is simply looking at like how many Bloomberg stories mention Bitcoin institutional adoption. You know, how many Google searches are there for Bitcoin? And if you overlay those, it matches the price perfectly.
Mhm.
So essentially what like the from a shorter term point of view, the best way to make money in crypto is anticipating narratives, right? Whether it's shit coins or Bitcoin or whatever. And from where I sit, I don't see any crypto positive narrative right now. And you can reverse the argument and say, well, the flows are really bad, so that means the flows are coming, and that's bullish. But I don't know. I don't really buy that, because then if there's a lot of flows, it's bullish, and if there's no flows, it's bullish. Well, you can't have it both ways. So to
Mm.
me, I just think institutional interest has not been as significant. You get these headlines like Michigan Pension Fund adds $6 million worth of Bitcoin or whatever, which feel good, because they feel like they're kind of adding to the narrative. But then when you look at the data, it's like there's just nobody's really buying it right now. So I think the issue fundamentally is that institutional adoption was actually the worst thing to happen to crypto, because now it's just so correlated to everything else that it's not really offering quite as much as people thought in terms of like diversification. The way that gold kind of goes up and down a bit randomly, when like you don't know what, if stocks are down 4%, you don't really know what gold's going to do that day. but you have a pretty good idea of what Ethereum's going to do that day.
Mm,
So I think institutional adoption, ironically, has been kind of like neutral because, like, yes, it attracted a lot of flows, but those flows aren't very sticky, and they're trading like the same way they would trade Nasdaq futures.
that's so interesting. I know whenever we broach this topic, especially when we're talking about no narrative, I'm sure there are a lot of folks out there that have one they believe in. Simmer down, everybody. Just tell us what they are.
Yeah, and I'm
We'd
happy
love
to
to
hear them.
hear.
Like,
This is a good.
yeah, because I want to know, like, I want to be early to find what the next narrative is, and then that's the ultimate way to make money is be right a little bit early, but not too early, right? So if
So
there
bring
is,
them on. Bring them on
yeah,
so we can
yeah,
know in case we're missing it, and
yeah,
we'll
absolutely,
happy to continue to discuss.
yeah.
Maybe we'll even do a special on it. We've got, I always like to flag who's coming up. We've got Noelle Atchison from Crypto is Macro Now, who is a sort of maven on that intersection between those things, and of course has been watching institutional adoption. So we'll catch up with her on that. But I love it, Brent. Thank you for sort of planting that flag, because I think it's going to be a really good discussion. Got to hit commodities really quickly because we have a few people in the chat asking about what your thoughts are about commodities.
Yeah. So the problem is that there's essentially three engines of growth, which has been Europe, China, and the US. And then obviously Europe and China are correlated. And China just looks so bad. Like, ever since 2020, we've been waiting for, like, there was the big reopening trade, and then the consumer stimulus is coming, and the housing bailout's coming. And like, Leland Miller from China Beige Book has been so good on this. He's just like, dude, it's not happening. They, they're not doing the old model. The new model is like moving towards more communist and less billionaires. And they're just gonna slowly watch a balance sheet recession, slowly watch the air come out of the balloon.
Mm,
And if it takes 6 years, it takes 6 years. I mean, it's already taken 4. Um, so ultimately, that's not very good for commodities. And then underlying that is this kind of permeable vibe in the commodities market, which is sort of started, I guess, because of Ukraine, and then obviously because of COVID, and has not worked. And interestingly, the way I said dollar yen is like the ultimate Veblen good, which is like people want to buy high and sell low. With commodities, it's just like the more they go down, the more people want to buy them. So that introduces like a bit of a risk. Now, some of the data shows that the market's not very long commodities anymore, but overall, I just think it's like a really stinky asset class. There's a lot of money has come into it in the last few years,
mm,
and honestly, like, in the last 20 years, there's only one asset class with negative annual returns, and it's commodities. And like going all the way back to like Malthus in 1850, this idea that we're going to run out of stuff just never happens, right? There's a lot of innovation, whether it was fracking or, batteries get better, this and that. We just never seem to run out of anything. Like, humans are pretty ingenious. So that's not a reason to be bearish commodities all the time. But this idea that, like, there's been a lot of shortage narratives through COVID and then through the Russia stuff. And I just don't buy it. And I think the price action kind of speaks for itself.
fantastic. That's a great point and a great stat on the negative returns. By the way, Ape in the chat is saying, do you read Brent's AMFX report today on the MWI of quantum mechanics? I don't know if you guys know, but Brent always has some great tidbits at the end of his report that we all love reading. And that was a wild one today. So I encourage you to go check it out. You're always expanding our mind, Brent, whether
I'm
you're doing it
trying.
in the note or in the school.
I'm trying my best. And if people want to see my stuff, they can go to spectramarkets.com.
Awesome.
SPECTRA.
Yeah, awesome. It's great stuff. I read it every day.
Thanks.
Brent, it was so great to catch up with you after a long summer for both of us. Appreciate it. Thank you so much for coming
All
on.
right. Thanks for having me.
And everybody, thank you for rolling up. Love the chat today. Remember to subscribe to the channel. And if you haven't already, join our email list so you can keep up with the very latest. I'll be back on Friday with Jem Carson of Kai Volatility, which is going to be awesome to hear what he has to say. He also took some time off this summer and he's just back making the rounds. So really anxious to hear from him. So please join us for that. In the meantime, everybody, take care and good luck out there.